In today's video, we are going to be talking about stock splits. Are they even beneficial to your portfolio, and why do companies even use these? And of course, all of the different things that happen when a stock does split. First, we need to go over the basics, and then, of course, moreover, later on in the video, we're going to go over some advanced issues with stock splits. Okay, so what is a stock split? That is what we need to try and figure out. Well, if you had one share of CIBC, which currently is a stock that just announced a stock split, CM.TO is the ticker. If you had one share before, you now have two shares. And that means that currently CIBC is somewhere around $160 a share. And that means that when it splits, you're only going to be worth $80 per share. However, you will have two shares instead of one. That's the basics of a stock split. And as you can see, there really is no major difference after a stock split, including dividends. This is a question that I've got a few times since I didn't mention that in a video. CIBC is splitting. And currently, they pay about $1.61 per share. Well, when they split, that's going to be about 80 cents and a half. So about 0.805. And that basically means the exact same thing. You're not changing anything at all. There is really no difference when a stock splits. And I'm going to tell you right now, the basis of a price of a stock is based on how many or how big of a percentage that those shares are being purchased and sold. So let's say, for example, if you were going to buy $100 or $1,600 worth of stock, and let's say before that would have been 10 shares, and now it's going to be 20 shares, the stock price is going to fluctuate the exact same because you put the same amount of money in. It's not going to change anything when it comes to people buying and selling, and of course it doesn't make any difference as to the percentage up and down for what the stock is currently being traded at. It's not going to make any difference. However, there are some benefits to a stock split. And it's not how you may think. It's not going to help you make more money, in theory. It's not going to change anything about the stock other than the price. And why does that make a difference? Well, it's because now, if you had, let's say, $1,500 worth of money, as an example, and that would have only been able to purchase about 9 shares, which would have equaled about $1,400 worth of stock. However, if you had $1,500 after the split, so this is before, now after, that $1,500 will be able to purchase 18.75 of a share. Now, of course, if you can purchase partial shares, it's going to make a difference because then you're going to be able to use all $1,500 worth of, or at least about $1,480 of the stock. Now, of course, most people, unless you are on a free trading platform, cannot buy partial shares, and this may not make a huge difference for somebody spending a little bit of money. But if we start expanding this to, let's say, $15,000, it does make a difference because now you can buy 93 shares before the split, and after you can purchase, after the split, 187 shares. What does this mean? That would equal about $14,960, while before the split it would have been equal to $14,880. That is a big difference right there between those two prices. You can actually buy more money worth of CIBC shares after the split by, if you're going, let's say, with $15,000, you can get a whole massive $80 more, which is one whole share of that stock. Now that's actually a massive thing because When you start looking at big investors, and I'm talking about people who are not spending $15,000, I'm talking about people who are spending $15 million or $150 million, the big institutional investors, that means that they can purchase more shares at the same cost or the same average. You get what I'm saying. The same amount of money that they want to put in, they can buy more shares, and they can buy a higher monetary value overall with the same amount of percentage of money going towards that stock. As an example here, $15,000, you'd be able to buy basically $80 more of that stock if you were to put $15,000 or had $15,000 allocated for that stock. You could buy $80 more worth of it. And if you go to $150,000, that now means $800. And if you go to $1.5 million, that's $8,000 worth of that stock more if you had that amount of money allocated for that stock. This means that because you've lowered the price of your stock, more shares and more money can flow into your company, which then means that your stock couldn't actually rise higher than it did before, mainly because of this one principle. The lower the cost, the more money can be put into the company because it's a lower individual value for the shares, so that if there are investors that have allocated certain money towards that company that they want to invest in, they can essentially invest more of that money that they've allocated to that business, which means that that stock can actually rise higher. This is a fantastic way for companies to help inflate their stock price just a bit more. It's not going to be a massive, massive jump, but when you start seeing over a long period of time, a 2-for-1 split every 10 to 15 years is what we usually see with Canadian banks. Every 10, 15 to 25 years, they'll do a stock split. And when that happens, over, let's say, your lifetime of 40 years of investing, if you stayed with that company that entire time, by the time you retire, that is going to drastically help improve your long-term gains. That's just the basics of a stock split and why it's actually beneficial, even though it really doesn't do anything day one. I hope that this video has kind of explained why stock splits are beneficial, and I hope that it kind of dies down on the whole estimations of what a stock split really does. I've seen people online commenting saying, wow, so they're going to be basically doubling my value of my stock? No, that's not how it works. Wow, I'm going to be doubling my dividend? No, that's not how it works. It's something very basic where it cuts the price in half, cuts the dividend in half, but you get double the amount of shares. And over the long term, there's going to be more people who can invest in that company, which makes you more money. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.